So if you've been keeping an eye on your AI stocks lately, you've probably felt that little knot in your stomach, right? I mean, after a year of just up, 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 the market's finally pulling back. And it's got a lot of us asking a really big question.
Is this it? Is the party over? Or is this something else? Maybe it's a much-needed correction that's finally going to let us see which companies are the real deal and which ones were just riding the hype train. Okay, let's get into it, because what's happening right now is super important to understand.
And that brings us to the big question of this whole correction. If we want to figure out what's coming next, we first have to really get our heads around why this is happening right now.
The whole mood has definitely shifted. That feeling of, blind euphoria from the last year, it's being replaced with a much more careful wait-and-see approach. Investors are finally starting to pop the hood on this AI engine, and they're asking some pretty tough questions about what's actually making it run.
Which brings us to a really core idea we have to get today. A huge part of this boom can be explained by something analysts are calling the AI circulation model, or as I like to call it, the great AI money go-round.
So what on earth is that? Well, put simply, it's basically a closed-loop system. Just picture a pool of money that just gets passed around between the same handful of players, making every single one of them look incredibly successful on paper. Now, this isn't automatically a bad thing. It's actually how massive projects get built. But it does make you wonder how much of this growth is coming from brand new outside customers.
Okay, so here's exactly how it works. Step 1. A tech giant, think Microsoft, pumps billions of dollars into an AI startup, like OpenAI. Step 2. OpenAI takes that huge pile of cash and immediately turns around to buy the one thing it needs most, GPUs, from a company like Nvidia. Step 3. As a result, Nvidia's revenue goes through the roof and its stock price follows. And here's the final piece of the loop. Who are the biggest shareholders in Nvidia? You guessed it. It's the same tech giants that made the first investment. The money has literally come full circle.
Analyst Jay Goldberg from Seaport Research put it, well, pretty bluntly, describing a hypothetical deal just like that. And this just perfectly captures the big worry here. Is this real demand from the wider economy, or is it just a really smart way for a few huge companies to pump up each other's numbers? The market is starting to suspect it might be more of the latter.
Now I know what you're thinking. A circular, hype-fueled investment cycle, this sounds an awful lot like the year 2000, doesn't it? It has that dot-com crash feel. But before anyone hits the panic button, it is so crucial to understand why today is fundamentally different.
This table really breaks it down. Back in 2000, most of those dot-com companies had no profits. None. Today, the giants funding this AI boom, Microsoft, Google, Amazon, they're some of the most profitable companies in the history of the world. The tech itself is mature and proven, not just a fragile promise. And interest rates, while they're not zero, are way lower than the 7 to 8% we saw back then. This isn't a bubble built on hope from everyday retail investors. It's built on massive institutional capital. The foundation is just so much stronger.
Okay, so if it's not another dot-com crash, then why all the sudden anxiety? Well, it's because the market is finally moving past the hype and starting to focus on the real, actual challenges that the AI industry is facing.
The first and, frankly, the biggest hurdle is the return on investment question. I mean, we're talking about hundreds of billions of dollars being spent on AI infrastructure. So investors are starting to ask, okay, when does all that spending actually turn into profit? The early excitement just assumed the payoff would be quick, but plugging AI into the real world is complicated. It's looking like the timeline for seeing a real return is much longer and a lot more uncertain than the hype led us to believe.
The second thing is a totally new kind of risk, what's being called the efficiency shock. We got a little preview of this with something called the DeepSeek shock, where a new AI model proved it could do really complex stuff using way less computing power. And this is the key point. What happens to the value of your billion-dollar data center, packed with today's best GPUs, if a new model comes out tomorrow that makes them 10 times less necessary? That threat of becoming obsolete overnight, that is now a very real concern for the market.
And finally, there's a hard physical limit we're running into: power. The International Energy Agency is projecting that the amount of power data centers use is going to literally double by 2026. This creates a massive bottleneck. It's not even just about the cost of electricity, it's about whether there's enough power available on the grid, period. You can't run an AI revolution if you can't plug it in, and that energy wall is a very real cap on growth.
So, with all this in mind, this new, more complicated picture, how should we think about our investments? The rules of the game have changed, and that means our playbook,
needs to change too.
All right, if you take away just one single thing from this entire explainer, let it be this. For the past year, momentum was enough. Hype was enough to inflate prices. But from this point forward, the only thing that's going to defend those prices is real, solid, verifiable earnings. The era of growth at any cost is over.
So what's that mean for you? Well, for beginners, the message is pretty simple. Stay calm. Keep up with your dollar cost averaging plan, make sure you're not way too concentrated in just a few of these hot stocks, and really focus on quality companies with actual profits. For investors who are a little more intermediate, it's time to do some homework. Start watching capital expenditure trends. When a company claims it's becoming more efficient, dig in and see if it's for real. And most important of all, when those earnings reports come out, comb through them looking for any hard data on AI's return on investment.
So, where does this all leave us? You know, it might feel like a pretty chaotic time, but chaos is often what comes right before clarity.
This is not the end of the AI revolution, not by a long shot. This is a healthy and honestly necessary reset for the market. It's the system shaking out the weaker players and the business models that just weren't built to last. When all the noise from that money go-round finally fades away, what's going to be left standing are the companies that create real, sustainable value. And for the patient, long-term investor, this moment of clarity, well, it might just be the opportunity you've been waiting for.
If this breakdown helped you make a bit more sense of the market and feel more confident in your strategy, go ahead and subscribe for more deep dives that cut through the noise. And for more daily insights, you can follow me on X. Thanks for tuning in.